Let's get more on the impact of the J&J news on the markets. Bring in Tony Dwyer, Canaccord's chief market strategist. Tony, great to have you with us. What is your take? Is there an impact on your market view?
It really isn't. No. The market, as they said, the economy's reopening. Thank God the vaccines are plentiful and they're being distributed faster than expectation. So the J&J news really didn't have an impact on my opinion.
Okay, but ahead of earnings season, you're a little worried, it seems, because you're downgrading the market view.
Yeah, it's kind of a rare downgrade for me, Mel. The permeable, pulls in the horns a little bit, and it's really based on four things. I thought that the 60 Minutes interview with Jerome Powell was pretty hawkish. It was a change in tone. So every time I'm on the show, I look into the camera and I say, the guy's printing the money, keep giving us the game plan, and they're going to keep printing the money. Well, in the 60 Minutes interview, he said something different. He literally said that growth was going to be strong. He didn't really hedge it. He said maybe having COVID-19 come back could put a risk into it. But he was very bullish on economic activity. And that was the first time I'd seen that. And when you couple that with following up on earnings season, there's a Duke University CFO survey. It polls hundreds of CFOs. It comes out once a month, and it's small, large company, private company, public company, domestic, international, and it hit the third highest level in history. So there is nobody on this planet that is going to be surprised by good earnings and good economy over the next 6 months, even to the point of Jerome Powell saying.
So basically, are you thinking that Jerome Powell saying it is sort of a contrarian indicator, or that he's starting to talk back QE in some way, managing the market expectation?
So, Mel, we try to make this different every cycle. And of course, the reasons for the recession are different each cycle. It always ends up in a credit crisis. And once you're in the bottom of the market, the Fed comes into the rescue, as they did this time. They game changed it this time on April 9th when they announced that they were going to buy corporate debt. That was a game-changing event, we thought. So, but each cycle, this is 2004. This is 2010. You're on the back of a monster move off the low. You've had an acceleration pending in economic activity that is very identifiable. It felt like during that ramp, the Fed is never going to say anything negative ever. And of course they do. So in 2004, you had about an 8% decline over a few months coming from a peak in April. And then in 2010, you of course had a peak in April, and you had about a 15% flash crash decline. So I don't know which one of those it's going to be, but I think the combination of those factors I said before, plus all the optimism in our four key tactical indicators being at historic extremes, gives an opportunity to maybe take some profit and be ready to attack when any weakness comes in.
Hey, Tony, it's Jeff Mills. Just a quick question to press this a little bit further relative to the Fed. We got some inflation data this morning, maybe a little bit hotter than expected. I know everyone has been expecting hotter inflation given the year-over-year comps. Can you talk a little bit about your thoughts on the data this morning and how that might factor into the Fed's posture here over the next couple of quarters?
Well, Jeff, as you know, the Fed likes to use the core PCE, personal consumption expenditures. It has a little bit of a less weighting in owner's equivalent rent. Today's number was a little bit hotter, but I think that's something that we knew. It's sort of, if you think about the 10-year note yield, we've had nothing but awesome economic news, which seemed impossible maybe 6 to 12 months ago. You've had awesome economic news. You've had now a surprise in the inflation picture a little bit. It was kind of expected. And yet the 10-year's gone from a 177 to a 161. Now, again, it's not the exact level that's important. It's the fact that in the face of all this excitement that brought Jerome Powell on board, that brought the CFOs on board. Oh my God, I'm sounding really embarrassed here. All of those factors combined with too much optimism just creates an environment ripe for a broader based pullback.
We're just about out of time, Tony, but I do want to clarify because you have been known as the perma bull. So is this just a trading call within a belief that we're still in an intact bull market?
It is, but it's a meaningful. I think we are early in a new economic and market cycle. And Mel, if you remember, when we went long the banks and tanks last May, it seemed impossible. Now everybody's in there and they're about to report great earnings. It's just a pause that refreshes and creates an opportunity to really capitalize on that next leg higher, which I think will be in the second half and into 2022.
All right, Tony, great to get your thoughts. Thank you.
Thank you, Mel.
Tony Dwyer, Canaccord Genuity. When the perma bull pulls in his horns, Grasso, that's got to give you some pause.
It does, but I understand. And I liked your last question. I think I know he said it wasn't, but I don't fault him for this. Once we look on a chart with the S&P and we get back to pre-COVID levels, you could have said, let's throw in the towel, let's cash out, let's get bearish. We're 22% above that level. And now you're going to look at a 6 or 7% print in GDP. Stimulus checks flooding people's pockets. Infrastructure coming down the pike. There's a whole lot of money being thrown at this, and inflation should be sky high through the roof. It's not. I think this market is going to rally because rally even further from here. What upsets the most people at the same time? A 4,500 print in the S&P, and that's what the market seems to do, Melissa.
Mm-hmm. Unless you counter that with a record high in the S&P 500, infrastructure gets done, but at the cost of, at the expense of corporate tax rates, which go higher, individual tax rates, which go higher. Guy Adami, there are a lot, there are reasons on both sides of the ledger at this point.
No, I think Steve makes a compelling argument. I find it interesting. Listen, one thing Tony Spin is perma right, along with Tom Lee. So let's just put that out there, number one. And when he makes comments like that, you have to absolutely listen because he's been steadfast in his views, and I'm not saying he's doing a 180. But he's clearly changing gears a bit here, so it's worth watching as we go into earnings season. Again, he made the point that when he made that call back in May, it seemed completely illogical. The call he's making now seems similar in this environment. And quickly before we get out, a stadium was something they had in Pittsburgh, that's Three River Stadium. A sports cathedral is what they have on 161st Street in the Bronx. Just to correct Tim quickly, sorry.
Amen. Amen.
Shepard Smith here. Thanks for watching CNBC on YouTube.